Hi, welcome to the Capital Region Skinny from the Greater Capital Association of Realtors, where we dig into the most recent numbers from our market. Let's jump right in. Economic recovery loses steam. Housing demand in a slump. Tax credit leaves mess in its wake. We're bombarded with headlines like these every single day. Some have merit, some don't. The truth is the economy is currently driving the housing market and not vice versa. It's the same old post-tax credit story for July. Frankly, we're growing quite bored with this recent holding pattern. Pending sales posted a 41.3% decrease from July 2009 to arrive at 552 purchase agreements signed. Many would-be July buyers already bought during the credit period. The tax credit borrowed buyers from May, June, and July and isn't giving them back. In fact, it seems as though the tax credit has strategically defaulted on its demand loan. As a result, inventory levels increased by a small but manageable 2.5%, as active listings stepped up to 8,658 units. Prices really lucked out, which likely reflects the mix of homes that closed during the month. The July median sales price of an even $200,000 was a welcomed 5.3% increase over last year at this time. Given the current demand picture, that may appear to be a major win, but it will likely change in the coming months if buyer activity isn't revived. Even negotiations are starting to feel the pinch as they move back toward the buyer for the first time in 11 months. The July percent of original list price received at sale decreased 0.9% to land at 93% of original list price. Typically, the housing sector generates a number of corresponding construction, manufacturing, and other skilled labor jobs, which in turn fuels economic growth. These jobs then return the favor by lowering unemployment and creating new demand for housing. And then there is now. Job churn simply must fill the demand gap formed by the tax credit before buyer activity returns to the market. The Fed's August 10th announcement that it will be purchasing Treasury bonds is a clear indication it wants to maintain interest rates at historic lows, an important driver of purchase activity moving forward. To sum up, the housing market is really trying to hold its ground until the job situation improves. Only after widespread private sector hiring will demand be restored to the market and prices continue to stabilize. Until then, it's a hurry up and wait game. That's the Capital Region Skinny for this month. Tune in next month for the latest.